The third buy-sell arrangement that we're going to look at is the share redemption agreement. It's probably the most complicated of the three that we look at in detail, and there are some provisions of the Income Tax Act here that are not always readily apparent. Once again, we're going to have the insurance owned corporately. Now, Jill dies, death benefit is paid to the corporation. We may or may not have a capital dividend account applied in this case. It's useful to have it, but a share redemption agreement can work without the capital dividend account. As we've seen previously, when Jill dies, Section 70 of the Income Tax Act calls for a deemed disposition of her shares. So her terminal tax return will show a $1 million capital gain, which may or may not be offset by the lifetime capital gains exemption. We do not have to have the lifetime capital gains exemption available to get tax efficiency out of the share redemption agreement. If we have it, great. If we don't have it, it still works. So now Jill's estate owns these shares. They have an ACV of $1 million and a fair market value of $1 million because they were deemed disposed on Jill's terminal tax return at her death. At this point, the corporation redeems the shares. The shares cease to exist. They're no longer there from Jill's estate. Now they have to pay them something for that, so they pay a $1 million dividend. They might use a taxable dividend, in which case the estate's going to have the tax consequences associated with that $1 million dividend, or they may have a capital dividend. In either case, the estate will be considered to have earned zero proceeds of disposition, because the dividend creates a circumstance under which we have a proceeds of disposition is based on the amount of cash paid less any declared dividend. So we're paying $1 million, but we have a dividend of $1 million, so proceeds will be deemed to be zero. And this is where it gets complicated. Because the estate has zero proceeds of disposition, but they disposed of property with a $1 million ACB, they will now be deemed to have a $1 million capital loss. So a $1 million capital loss now cannot really be used by the estate. Instead, the estate can carry back a capital loss that happens in the first year after Jill's death, and we can apply that capital loss on Jill's terminal tax return. You'll remember that Jill's terminal tax return showed a $1 million capital gain because of the deemed disposition of the shares. However, we can now use this capital loss to offset that capital gain. So in essence, we can wipe out the capital gain that would otherwise have had to have the tax paid at the time of Jill's death. Now, if we did have a taxable dividend paid to Jill's estate, then the estate is going to have to pay tax on a $1 million dividend. Alternately, the corporation could have paid, as I had suggested at the beginning of the share redemption agreement, the corporation could have paid a tax-free capital dividend. But you can't have a tax-free capital dividend and a carryback of that full capital loss. That violates what are called the stop-loss rules, which really prevent that kind of double dipping. Because if we can do that, if we can have the tax-free capital dividend and the carryback of the capital loss, it wipes out the tax consequences. It's really a too good to be true situation. So the stop-loss rules would prevent us from having no tax consequences at all. We are going to have some tax paid by either Jill or her estate. The stop-loss rules actually say that you can't carry back the capital loss if more than half of the purchase price is paid by a capital dividend. So there is a fairly tax-efficient way to manage this, and what you can do is pay up to half of the purchase price as a tax-free capital dividend, the other half as a taxable dividend, and that still allows the full capital loss to carry back to Jill's terminal tax return from the estate. It's probably the most tax-efficient way to do it. You do have to take into account it still results in a taxable dividend, although only half the taxable dividend that would have otherwise been left. And of course, it leaves the upside that we don't clean out the capital dividend account. It still leaves some capital dividend account credit for the remaining shareholders to use later on as they see fit. In the end, Jill and her estate no longer own any shares. Those shares have been redeemed. Steve is now the 100% owner of the shares of the company by virtue of the fact that he is the only owner. His shares have essentially doubled in value. He represented 50% of the ownership previously. The other 50% owner is gone. Now he owns 100% of the shares in existence of this $2 million company. He hasn't done anything to change his adjusted cost base for those shares. His ACB in this instance is still zero. It does lead to a form of double taxation. We'll talk about that momentarily. And he may have access to some capital dividend account credit, as mentioned on the previous slide, if there was any capital dividend account credit to start. The upsides of the share redemption agreement, it works well when there's no capital dividend account available. That's going to be the case if we have a critical illness or disability insurance buyout. Of course, you can go back and check some of the situations that we talked about earlier to review that. It does not require the lifetime capital gains exemption in order to be effective. And for that reason, it works well with very large buy-sells where the value would be well in excess of $1 million, because it still creates some tax efficiency, and it creates that tax efficiency if we're doing a $5 million arrangement or a $10 million arrangement or a $25 million arrangement. And you can see that as those values get larger, the appeal of the lifetime capital gains exemption becomes less and less. And it may leave some capital dividend account, if there ever was one, for the surviving shareholders. The downsides, it's a fairly complex arrangement. It's sometimes hard to understand and therefore hard to explain. The thankful thing there is that it is common enough that your average lawyer who does buy-sell arrangements, your average estate planning lawyer, will understand how this works. And there's no increase to the survivor's ACB, so this can be a problem because effectively we're creating a form of double taxation here. In the case we just talked about, Jill would have had tax consequences to deal with on her shares, and then we redeem those shares. Steve got no increase to his ACB. He is in fact going to end up having tax consequences related to the same increase in value on which Jill will have already paid tax.